Well, thank you very much for listening to me again, this time on the G7 countries. Please don't get depressed. Uh, it doesn't look good. Um, the first thing is, let's remember what debt crisis look like. You have interest rates going up, export revenues going down, GDP collapsing. In the developed world, you don't have debt crisis as such. What you have had is economic crisis because of falling rates of return. The profit rates go down to nothing, and then the system collapses and you start again with new technology, which is reflected in this way in the rest of the world. Now, this time around, we have, let's recapitulate. China shut down in February. It had already been shut in January because of vacations. And I think John and Mick can correct me there. But as far as we see in the data, January is a month where nobody works. February was shut down. The global value chains slowed down first, and then supplies became scarce, and then finally they ground to a halt. China reopened in March, in April. And when China reopened, the rest of the world was locking itself down. So what you had was, on the one hand, a shutdown of supply, and on the other hand, a reduction of demand. That happened the world over, and in the G7 countries, it happened more, because in the G7 countries, you have greater industrial production in most, save Britain. The rest of the developed world has a large industrial production that ground to a halt. So you have there the origins of the second quarter collapse, where with the second quarter collapse, you have tax revenue being severely affected. And what you have then is a recovery of China. And with China's recovery and the West being in a contraction, what you have is the economic axis, the world economic axis shifted from the Atlantic to the Pacific. And that's for keeps. That has happened this year. It was happening, now it has happened finally, completely. So now, from now on, we have to look at China to see what the world dynamics look like. We did the same exercise we had done for Latin America to take a look at the country's GDPs in the second quarter and see what they looked like. And we had that Italy had lost 27 years, France 17 years, the United Kingdom 17 years, Canada 7 years, Germany 6 years, Japan 9 years, the United States 5 years, the average European Union 10, the G7, because of the US's 5, is only 7-year loss. So the G7 lost 7 years, Latin America lost 9 years on average. They lost about the same. The recovery in the third quarter, Italy recovered everything it had lost. Now, like with the Brazilian case, recovering everything you have lost does not mean you have economic growth, because you were not growing to begin with. So you have recovered the loss of the second term, but you are back to where you were before, which in the Brazilian case was -5. So they were back to -5. In the Italian case, they have recovered completely and their economic growth is extremely small. France recovered 82%, the United Kingdom 2/3, Canada 2/3, Germany 1/2, Japan just under 1/2, and the US 1/3. So you have some recovery, but not a whole lot of recovery. And you have From Germany to the right, Germany, Japan, the US, the recovery is weak. To the left, Canada, the United Kingdom, France, and Italy, it's a bit stronger. In the blue lines are the fiscal policies, the green lines are the monetary policies. What we see in Italy, it's a lot of monetary policy with very little income policy. France, the same, the UK, the same. Canada has more fiscal spending. Germany has more fiscal spending as much as monetary. Japan has more fiscal spending, but monetary policy is a lot stronger. And the US is basically fiscal, with one small part, which is for us very important, that small part, which is a monetary policy. The result is, and here we are, you have the total GDP deficit in for all of the G7 countries. It's grown to about minus 15, just under minus 15. So it's a major leap. So that's a lot of borrowing. That's a lot of borrowing. But here we have that Canada put between the fiscal and the monetary, put 20% of GDP in the economy. France put 10% of GDP. Germany put 8. Italy put about 14. Japan almost 15. The UK over 15. The US nearly 20, 18.9 something. It's a massive fiscal and monetary stimulus added together compared to the previous year, which is a green bar. It's a massive change. And that massive change can be seen here. Canada increased its public debt ratio by 22%, France by 14.6%, Germany by 14.8%, Italy by 12.7%, Japan by 6.6%, the UK by 18.9%, the US by 17.5%. This has taken us to a new situation in the stock market.
Oscar, you're frozen. We didn't hear you after the new situation in the stock market.
And in the,
Sorry, 1 second, please. Okay, go ahead, Sasha.
Okay. And in the bond markets, in both markets. Okay, now what we have seen, and this we had already seen it, is that raw material prices, the Fed injected liquidity to the investment banks on March the 23rd, and that pushed up the stock markets and pushed up the commodity markets. They also reduced the interest rates to 0.25%. International trade volume collapsed, exchange rates jumped, and stock exchanges did very well. Brazil is a reflection of that. Here you have the stock exchanges. When we look at the detailed stock exchanges, things change slightly. First of all, the UK, which is this one here, this blue one here. What did I do? This dark blue line here, that's the Financial Times Index in London. That has fallen from 100 and is now 15% under what it was a year ago. Singapore, which is the next one up, has also fallen from January of last year, to my surprise. I didn't expect that to happen. I expected Singapore to go up together with China. It has not. What we have is the Germans remaining fairly stable. That's the brown or dark orange line here. This line, this dark orange line, is the German index, DAX. That's slightly over, it's 8% over what it was a year ago. The Japanese index has followed the US index, that's the yellow line. And Shanghai has also followed the US trend. Shanghai has also gone up. So what we're watching is some sort of market segmentation here. I don't understand how it is being segmented. The UK, I understand, because that's people leaving their investments in Great Britain and investing someplace else because of the Brexit, plus of the economic situation. Singapore, that has not had a problem with the pandemic, does not have an economic problem as such. Yet, the index has gone down. And there must be some relationship with Great Britain there that I am not understanding yet. The others seem to reflect US monetary policy. The US injected money, and that money goes through the investment banks towards the stock exchanges in Tokyo, in Shanghai, and from what we have just seen in Sao Paulo. So we have this massive, exuberant bubble while the economies are collapsing. And that's a reflection of US monetary policy, and that will not last forever. That's just for now.
Oscar, you are above 10 minutes already, just so you know. Yeah.
Total freight, as we saw, went up. Now, how can the global container index go up when we know that trade has gone down? The answer is you put commodities into containers and you put the ship on the sea. So what you have is ships filled with copper, oil, silver, whatever it is, floating, navigating, and they go to port when the price reaches the correct level. And that's why the volume has gone up. This is physical volume of freight. But when you look at trade, what actually went into the ports, it's not a reflection of this. So this is a speculation. This is an index of a speculation. What have I done? This is the currencies of the G7. You have, this is all to the dollar, okay? They all began the year at 100, and you have an appreciation of the pound. The pound has, no, this is a depreciation of the pound. The pound has gone down.
I don't see the pound.
This is the, I think this is the pound.
Oh, Libra. Okay, yeah, I got it. Yeah.
Libra. Yeah. Then, or isn't it? You have the yen.
It is appreciation. The lower lines are appreciation, and the upper line
is appreciation. Yes. But with the pound, because it's over 100, because it's 125 or something. So when it, what am I doing? No. Yes, this is appreciation is down, depreciation is up. So all of the currencies started at 100, jumped in March, and then came back to the point of origin or under the point of origin, much like in Latin America. And much like in Latin America, one remained above, that's the ruble. The ruble is to the G7 currencies what the real is to the Latin American currencies. It's the currency that has devalued, and it has revalued and remained devalued. It has not recovered. I have no idea why this is so. It might have to do with stock exchanges, I don't know. But what's clear is that if everybody has an appreciation, the dollar is depreciated. That's what's really going on. So we have to look at this in the opposite. What's really happening is that the US dollar has been depreciating for the past year after March, which is correct. I mean, you inject a lot of liquidity in US dollars and the value of the dollar is going to go down. And as the value of the dollar goes down, the other currencies appreciate. And that's what's happened in Latin America and with the G7 countries, except for the ruble. I have no idea why my assistant did not put the yuan here. He certainly missed the yuan, God. But I understand the yuan is appreciating as well. And they can be corrected on that one. Now, as far as debt is fiscal, the debt problem of the G7 countries, here we have basically all of Europe, plus the States and Japan and Canada. And apparently, the rule is that if you're a rich country, you owe over 100% of your GDP. That's the fiscal debt. Everybody in 2019 had almost 100, save a few countries. The few countries were Finland, Germany, Russia, and in fact, Great Britain was all the way up there as well. It jumped, much like in Latin America, it jumped from substantially, the index jumps between 19 and 20. The reason why it jumps is the same reason as in Latin America. That's because GDP contracted. As GDP contracts, and the debt is the numerator. What you have is a jump in the data, but it's only, as we have seen, in real terms, it's just some percentage above what it was. It's on average, it's 15% more than what it was, but the index has grown much more than 15%. And that's because of the contraction of GDP. From our projections and with our little, very modest econometric model, what we see is that the future of Europe will be with very high levels of debt. They will remain over 100 for more or less everybody. The Germans will manage to reduce their debt. Nobody else will. Everybody else is all the way up there. And it doesn't, I mean, by the looks of this, it doesn't look as if Europe is going anywhere. And it doesn't look as if Japan is going anywhere. The Japanese debt was 238% of GDP. It jumped to 266%. And in 5 years' time, it will be 265%. So that economy cannot possibly grow. It's spending most of its budget money into debt payments. It's Brazil in a large scale, in an even larger scale, if that's possible. So this is what it looks like. Mm-hmm. Now, maybe that's the new world. I mean, maybe the new world consists of having these hyper indebted governments that just roll over what they owe and pay interest. And of course, as long as the interest rate is 0.25%, not 0.25%, there's no problem. But the average interest rate in the G7 countries is 4%. Now, are we ever going to go back to the average? Or has the new normal been established after 2008 and there will never be a 4% interest rate? That would be a reflection of the profit rate. That would mean that the profit rate has gone down to almost nothing, and that you cannot raise the interest rate because no economic activity could cover it. So that's where we are. And I think that poses a major question on the future of the West. The leading economy now is clearly China. The economic axis is to the east. It's on the Pacific. They don't have these numbers. They have a totally different set of numbers, and their numbers look much better than the West or Latin America. So I think we are in a totally new world now. Right. Thank you very much.
Great. Thank you, Oscar. I guess we also have a different new normal. I think we'll have to extend the speaking time to 20 minutes because that is the actual new normal. But thank you very much. And the questions for Oscar, please. Alan.
Yeah, I think this is absolutely fascinating, and thank you very much. I'm very interested in the relation between what has happened in the pandemic and the long-term trends that preceded it. Because what always happens in every financial crash, and this was actually a coincidence of the pandemic with a financial crash which was coming anyway, is they always blame it on some special case. So 2008, it was the crazy speculators. 2000, it was .com. The one before that, it was the oil crisis. But actually, it's the business cycle, okay? Now, so that's one point. But the second point is there has been a very long-term trend since at least 1974 and probably the mid-1960s of a slowdown in growth in the what I would call the northern economies. Mm-hmm. And by the last decade, if you map the growth over the business cycle, right, trough to trough, mm-hmm. it's practically zero in the last decade. So I just wonder if this new normal was actually established in the years preceding the pandemic. That's my basic question.
Well, what it looks like is that after 2007, the debt levels jumped and they have never gone back down.
Yeah.
Public debt jumped all the way up to rescue whatever it was they rescued, and it's remained. And the rate of economic activity, as we clearly know, is nil. So we're having these booms in the stock market with this massive public debts, with no economic growth, and we're making believe that the credit system is keeping the economy alive. And how can you keep the economy alive with a credit system when the employment mass is being reduced? I have no idea. I mean, but there's something here that I think is not being clearly understood yet.
Maria, and then I have a question. And Mick has a question.
Yes, yes, a very good point. The credit-driven economy, which are the limits of this credit-driven economy. How are we going to pay back the debts if you have no employment? This is, but I'd like to ask you. It is something about what are the lessons from Asia, mainly from China. This is a point that you arise, and then here in Brazil is some economists are thinking about, well, what can we learn from China? What can we learn from China if we see these numbers in terms of GDP? And know that this is really a threat to democracy. How can we link this? Because if this is a new normal or this is a threat to democracy? If you, it is difficult because I think that there are many issues. There is a pattern of growth. There is a Western pattern of growth that is unsustainable, but as you say, it's credit-driven, it's unsustainable. You need to rethink the pattern of growth in a moment where we have this GDP debt that it is really challenging in terms of the management. But if you look at the lessons learned from China, then we see a government that we have no democracy, and how are we going to learn from them? Sorry, not done.
Yeah, this is a very good question, and I'm going to have to bring John in because, of course, he runs a blog entitled "Learning from China." But I'm going to let Oscar answer first, and then go to John.
Okay, what I would suggest, Maria, is that I do what I have just done for Latin America and for the G7 countries, for the Asian countries.
That would be great.
And take a look at what those numbers look like so that we can have a contrast. And I will include the investment rate, which I have not included. I have looked at them, but I have not put the table. And put the table, the investment table, for Latin America, for the G7, and for Asia, so that we have the complete picture of what this is looking like. And I will follow in our little briefs that we do in the observatory, I will try to follow the Asian economies employment profile. We are looking at the G7 employment profiles and at the Latin American employment profiles. Now we're going to look at the Asian one so that we have more food to understand what is going on. Okay?
You are on, Oscar. Okay, you have about a month to come up with this. I have John, Mick, Attila, and then I will put myself last.
Right. Okay. Well, first for Maria, you can read my article in the book in Portuguese, published. Sorry, I've got a phone. Can you take somebody else? I've got a phone call coming in from my daughter.
Yeah. Mick, you're muted. You are still muted for some reason, Mick. Hang on. Please unmute. That's better. No, that's better. That's better. Go ahead.
It's just a question to Oscar. I mean, in relation to the differential behavior of these stock markets in the first place, I just wonder, you know, in 2013, the United States established these currency swap arrangements with a number of countries, you know, the United Kingdom, with Switzerland, with Japan. And then in the pandemic crisis, it established currency swap agreements with quite a large number of other countries, which include Brazil. These swap arrangements were designed to provide some kind of liquidity guarantee, as I understand it, for these countries. And that is, you know, it was very sort of seemed very geopolitically motivated, but in a sense, it enables them to put a line under their currencies and under their financial markets. So I wonder if it might help explain, you know, some of the phenomena that you observed. So that was the main comment to you. I was just going to add, you know, that, you know, we have to put what you've just presented in a context in which the world faces not just the challenge of the pandemic, but it faces a serious challenge of decarbonization. When you start to put these challenges alongside the challenges that you mentioned, I think it makes the situation seem yet more serious in many ways. And I wanted to comment to Maria, please. You know, democracy is a generic concept. Democracy can be established in many different varieties of ways. You should not assume that a Western model of multi-party parliamentary democracy with periodic elections is the only form that democracy can assume. And I actually would seek to defend the idea that China can make a legitimate claim to being a democracy.
Great. Responses.
I can come. Can I come in?
Can I just take a few questions? Otherwise, we'll go on forever. So please make a note of them. I have John. You please go. I have then Attila and then Mick Burke.
Yeah. Okay. Right. Maria, I just meant it seriously. I have a chapter called "Lessons of China for Latin America" published in Portuguese. So I'd be very pleased if you could read that. Right. Okay. Secondly, the fundamental conclusion to be drawn from China is that socialism works, and it works not merely for the future, it works now. The decisive factor about the Chinese economy is that 40% of the investment is controlled by the state, which is enough to control the overall level of investment in the economy. So they control the economy by moving the level of investment up and down. And as was already pointed out, the level of investment in China is 43%. of the economy. So that's how it works. On the political system, I would agree with Mick, but there's another issue. You don't have to have China's political system anyway to have a Chinese style economy. Actually, some Latin America, the country which comes closest to China in Latin America is Bolivia. Not in the level of investment, but it's pursued a very intelligent policy of raising the level of investment within the economy. And this is one of the reasons for the success and the popularity of Morales' government, because it's the closest outside of Asia, it's the closest approximation to what's happening in China in the world. Okay. On the questions, I would just add to what was said in the report. The effect of the pandemic on the world economy is going to be gigantic. To give you the IMF's projections, 60% of world economic growth this year will take place in China. More economic growth will take place in China than the rest of the world put together. Even if you take out the period from now to 2025, 32% of world economic growth will take place in China compared to 10% in the United States. I'm hoping to have published in about 2 weeks' time a collection of my articles which are in English, because they've mainly been written in Chinese. So I'm hoping that will then be available. This contains some points about the question in Latin America, and of course I'd be very pleased if anybody then read them. Thank you.
Okay, I think Attila, and then well, Attila, and then we will take some answers, and then last 3 questions. Yeah.
Okay, so also listening to the Brazilian case, and then this super intro into this crisis by Óscar. I think there has been a lot of talk about that, economic theory is rewritten in terms of, low demand, financial boom at the same time. But I think we can actually reverse this. It seems that this is really going to be a major crisis on all fronts.
Yes.
So the point is, what I'm asking is basically this, that it is actually no need to speculate whether they can survive this. They cannot survive this in the longer run, which means that there is going to be a production crisis, there is going to be a complete financial and debt crisis. The Kondratyev cycle is down, as I learned it from Mick. So all the things are together to have an amazingly big crisis, which is going to be put in this way, a transformative crisis, as John is saying, completely changing the economic centers of the world and how the whole thing looks like. And then we can actually figure out what type of a new economy is emerging out of this. We don't know it yet. But no, I'm just asking that, putting these things together, because I have been all the time thinking about this. How is it possible? How is it possible? How is it possible? But now I'm coming to the conclusion that it is not possible. It means rationally we have to say that we have 1, 2, 3 years to see the whole thing to collapse. I mean, I know it was always a bad thing to say. I mean, Marx was waiting for the crisis for I don't know how many years, between 1952 and 58 or something like that. But I think I am exactly the same feeling like Karl Marx in the 1950s. I just want to read it now. So it's really coming. So that was the point what I just wanted to make.
Great. Óscar, some responses, and then we'll take a last batch of questions.
Okay. A ver. The US has not established any new swaps with new countries. The swaps it has established were established first in 2008, 9, and they're the same ones that have been renewed. What has happened is that they were not renewed, and last year, 2020, they renewed everything as the perspective grew grim. No, it's basically the Fed has swaps with South Korea, Mexico, Colombia, and Brazil, and of course the European Union. Basically, I don't remember who else, but that's basically it. We have a shift of axis that puts the center on Chinese dynamics, which is what John has said. Now, as we have the shift to Asia, in the West, what we're having is a technological change that is already taking place in the East. It's being led by the East. When you see clean technology, electric cars, solar panels, decarbonization, all of the technology related to that comes from China, all of it. And the West is being very slow, and the US has been the slowest. Now, Latin America in this scenario is out of the game, except for Chile, maybe, that is changing towards clean energy. Most of the rest use petroleum as an export and as tax revenue. That's the case for Brazil, that's the case for Ecuador, for Colombia, for Venezuela, for Mexico, Peru. Some countries have more oil than others. 3 countries are damned. Venezuela, Colombia, and Ecuador, they're dead. The others, if they can do something with gas, with liquid gas, they're someplace else. If Brazil manages to produce liquid gas and to compress liquid gas into batteries, those will be the batteries that will use lithium for the electric cars. Lithium batteries use lithium and compressed gas. So the new market for gas is batteries, lithium batteries for electric cars. And it is not only electric cars, now it's electric ships, and they're working on electric airplanes. So we're going somewhere in that direction. So that's gas for the future. That's what gas market is about. That's why Shell announced this past week they're getting out of the oil business. Sure. Why be in the oil business when you can be in the gas business or in the solar business? But the Latin American oil companies have not made the shift. They're still producing oil. I mean, it's pretty dumb. The other and the last thing is we have a crisis there. The crisis has to do with this 0.25% interest rate is the longest ever there has been a negative interest rate in recorded history. That's 200 years of interest rate record. Never has there been such a long period with a negative interest rate. And that's the result of profits just going down. And I mean, there isn't sufficient profitability to pay the interest. So the interest goes down. And that's it. And unless we change the technology to recover profitability, we're dead. So that's where the West is going into a crisis while the East is booming. And that change in the axis, as John just said with those numbers, is going to remain. So we're in a new map now. And that new map is going to generate what we have been trying to study with Maria in this conference that we did with the World Economic Association on the trade wars and the new Cold Wars. And both, they are the same thing. It's containment of the other one, no? It's the West containing the East from advancing. And I also think that we can have a Chinese economic model without necessarily having to import its political model. What's clear is that the concept behind Austrian economics is dead. Market economy as such has proven what we're looking at. Over-indebtedness by the state, by consumers, no growth, and massive unemployment. Where is this going? Nowhere. So theoretically, that's dead. but there isn't a theoretical response yet, and I think we have to make this is a space to propose a theoretical response to the collapse of the other side, I think.
Thank you, Oscar. Mick, and then I, and then that will be the last two questions, as far as I can tell. So Mick Burke, please go ahead.
Thanks, Radhika, and for organising this. Sorry I haven't been able to attend the earlier ones. I think this has been great. I thought Oscar's presentation was excellent and lots of food for thought, and very much agree with the central point of the rebalancing of the world economy towards Asia in general and China in particular, and away from the Western economies, which of course has all sorts of social consequences. And one of the political consequences has been a frenzy of hostility towards China in the West. As a small aside, as someone who lives in Britain, a country where we learned recently the monarchy vetoes legislation and has done so 1,000 times, I'm not that big a fan of Western liberal democracies, so-called. On the substantive issue, I'd just like to reinforce some points and take it in the direction of the consequences of the crisis. The International Labour Organization has had a report out in January where it started to itemize some of the effects of the crisis. What they reckon is that globally there are 114 million people being made unemployed during the crisis, and that in the full-time equivalent jobs, another 140 million equivalent of hours have been lost. This is overwhelmingly concentrated in the rich Western economies, not in the global South, what some of us call the imperialist economies. And that can't be due to lack of resources. Self-evidently, they have far greater resources than the global South. What this is, I think, is quite clear, is this is the continuation of the struggle that really began in earnest in the end of the 1970s, beginning of the 1980s. The Reagan-Thatcher period, what people have come to call neoliberalism, which is an all-rounded attack on the working class and the oppressed in terms of pay, conditions, hours, every aspect of work, huge transfers to the capitalists, and an undermining of labour rights. All of that goes to an increase in the rate of exploitation. They basically had a bite at the cherry after the 2008 crisis with austerity in 2010, but it didn't quite hit the mark. They didn't actually substantively increase the rate of profit in the Western imperialist economies, and they're not letting the Rahm Emanuel phrase, they're not letting this crisis go to waste. They are really very, very determined to ensure that this crisis is the one that gets them out of their long-term crisis of profitability. That's it for me.
Okay, and I guess I just wanted to, again, Oscar, your graphs and charts are really very thought-provoking. So I'm going to really hold you to doing that new section on the Asian economies. But I think we somewhere have to factor in a change that took place in the 1970s, a little bit before the onset officially of neoliberalism, and that is the beginnings of financialization, beginning with the US lifting capital controls after the oil shock, and then with the Volcker shock. Because basically what that has done is it did several different things, but essentially that is around the time also when credit and the financial system expanded massively. Okay, this was not so in the case before. In fact, the neoliberals even invented this expression, financial repression, in order to refer to the post-war period. So I think those changes are definitely part of what we have to understand, because also governments that used to, as far as I understand, monetize their debt, began to borrow from from the private sector, essentially also creating for the private sector a class of safe assets, which then cushion their more risky speculations, etc. So I think this is that whole cycle is now coming a cropper. It's now coming to an end. I agree. And I think it also has to do with something else. Neoliberalism essentially said they are that, freeing capitalism from the dead hand of the state and from union power is going to solve everything. It is going to revive its mojo, etc. It's going to revive competition. And but the fact of the matter was that capitalism was no longer in its competitive phase. And the only thing neoliberal policies achieved was a massive expansion of finance, which has been, and finance systematically narrows the productive base, so that it is in fact a huge contradiction simply playing itself out. And now we are seeing the last phases of its playing itself out. I just wanted to throw that in. So I think we really have to factor those financial changes in order to understand what's happening to these economies. And state debt is the last recourse, but at the end of the day, state debt itself is going to be problematic, right? I mean, the only way, it will become very clear the more and more financial sector relies on state debt is that what they are relying on is the state's political capacity to tax. They're doing absolutely nothing to expand the economy. Oh, and I guess Carlos has a question. I'll let you put that and then we will go to Oscar for a last round of responses.
Thank you. Sorry to come in late. Yeah, I just was inspired by Oscar's comment that Western countries can adopt China's economic model without necessarily needing to adopt its political system, and I think that sort of raises an interesting question of political will, because yeah, on the one hand, they can do it, but it's a completely different question of whether they want to do it. And that's a political issue. And it reminded me of a very nice quote from a Chinese political analyst, and I think a venture capitalist, basically, Eric Lee, who's interviewed in John Pilger's film, The Coming War on China, where he's talking about the difference between the Chinese market economy and the US market economy. And he said, in China, the capitalist class, we have billionaires and they exist at the grace of the CPC government, whereas in the US, the government exists at the grace of the capitalist class and the billionaires. So the question for the West is really, yes, we can reorient the economy and we can prioritize the interests of ordinary people, and we can fix our investment rate, etc. But do we want to do that? And that's related to Radhika, what you've said about the financialization of the economy and whether there's any incentive to produce sustainable growth for the whole of the society. And it's tempting to think that we can fix all these problems purely with economics, but actually a lot of it is fundamentally a political problem.
I couldn't agree more. I just want to say two quick things to reinforce, because I had it written down and I didn't manage to say it, but it's a question of political capacity. Actually, I don't think all countries can simply implement China's policies. The fact of the matter is that it's only when I remember on my first visit to China, saying to the friends that I was with, I said, what explains the difference between China and India? The answer is encapsulated in a single word. It's revolution. That India did not make revolution, and it's because of its revolutionary character that the Chinese state has the capacity to do what it's doing. So I agree with that. And I also wanted to add that the Chinese financial system is completely different. And that's why China can do what it's doing. That's another thing. And it's different for historical reasons. And all the most productive economies of the world historically have had very different systems. I recently wrote, a lot of people don't recognize this. People say, oh, Hilferding wrote this great book about finance capital and it helps us to understand what's going on now. No. What Hilferding said was that the financial systems of the model countries of finance capital were precisely the opposite of the British style system that has come to dominate today. So he actually contrasted the two models, and that contrast, I've written quite a few papers recently where I have revived that contrast in order to understand what's going on today and the different financial systems of countries like China, for instance, and countries like the UK, US at the moment. And the US used to have what Hilferding called a finance capital model, but over the last several decades, it has been completely transformed into a British style, short-term, predatory, speculative, unproductive financial system. Anyway, so Oscar, your last responses, please.
It's pretty broad. Before answering, I will, a little propaganda. Walden Bello made a synthesis of Capital and Ideology by Piketty, the 1,000-page book. It is 32 pages long. We are, together with Walden and Nicola Boulard, going to produce a translation, the English version done by Walden, Nicola the French version, and I have done the Spanish version. So we're going to start circulating this, and if somebody wants to join in and do the Portuguese version, please say me. I will send it to you. You put it into Portuguese, and I send you the English book by PDF so that you know what page number you're going to, and that's going to be very helpful. That's one thing. The other thing is, we can, I think, imagine something changes, but what we have to take into account always is the way the US interferes. I have no idea how aware you are of the US asking Lenín Moreno to sign an agreement to not have further relationship, financial relationship with China in exchange for buying the debt of the dams. There are 8 hydroelectric dams constructed by the Chinese, paid for with copper. That's the agreement. The US has said, let's buy the debt and we will pay the Chinese, and you don't have any further agreements with the Chinese. That's what they're doing in Ecuador. We have seen these funny things with Brazil that have yet to become more clear. In Brazil, a Chinese firm bought Duke Energy. Duke Energy had a $14 billion US investment in electric distribution, basically, and some generation. They bought it, paid $14 billion for it, and now it's Chinese. Then the Chinese invested in solar parks, and that's being hooked into the grid, into the distribution grid. So the Chinese are advancing clean energy in Brazil. And once it happened, suddenly somebody in the US reacted and said, no, this can't happen. And so now you have all kinds of problems that are starting to appear between the energy, inside the energy sector, between the Americans and the Chinese. And Brazil is a football game. It's a football field for this. That is our problem in Latin America. The US interferes always because they consider that we are a part of their territory. And that's a damn problem, because every time you try to do, look at what happened in Bolivia. The coup d'etat in Bolivia was done because of the lithium and the projects with the Germany and China. And we just found out 2 days ago, doing an article on gas, that Janine Áñez more or less canceled the agreement with Argentina, the gas agreement. That was going to lead Bolivia into a major crisis this year, 21. Thank God there were elections. Thank God Lucho Arce was elected, and they have announced a new finding of gas, and they're going to reconnect their agreement with Argentina. But that's US interference to provoke an economic crisis, to induce an economic crisis in Bolivia. I mean, that's the problem. Now, how can we get rid of this interference? I don't know. I don't think we can get rid of it. I think we can control it, but we need, for that, I think we need more popular consciousness, more politicization. We used to be a politicized continent. And over the past 30 years, because of the Austrian thinking and the disappearance of trade unions and so on, we have lost our capacity to organize ourselves, to think with our own heads, and to act. So now what you have had over the past 20 years is these progressive governments that don't seem to be very progressive. And something is better than nothing, granted. But I mean, there could have been many more things done than were actually done over the past 20 years. So I fear that unless we make this more political, there is no chance that this will be just an economic model being taken over. Hardly, I don't think.